We've been having interesting conversations this morning, and I want to say big thanks to the organizers of Nigerian FinTech Week for putting this together. I and my colleagues here will be discussing the future of FinTech, technology in Nigeria, in Africa, and where we are going from here. There is something I always say, that technology does not start and end with FinTech. Am I right? There is the insurance tech, which we call insurtech. There is agrotech, and there is edtech. And today, we are going to put some light, to shine some light on where we are and where we should be. Permit me to read something I've put together for introduction. Do you know that in Q1 2021, the Nigerian fintech industry generated about $293 million in revenue? This revenue is now projected to reach $500 million by Q4 2022. A huge growth, you would say, from the $178 million, which we had in 2018, and $153 million, which we had in 2017. In this panel session, we are going to be going down memory lane to examine how technology has affected our economic growth and to chart new path for sustainability and development of technological ecosystem in Nigeria. Okay, so thank you. I am going to be starting my questions with Sheol. Hi, Sheol. Is Sheol here? He's not. So I'll be starting with Bayo then. He's still not here. He'll be joining us. Okay. Gerald is here. Gerald, tell us more about what is the difference between earned wages and salary loan. Before we go full stack into the technology business, tell us about earned wages and salary loan, the difference. Thank you.
Thank you, Wale. Good afternoon, everybody. So just to get right into it, earned wage access, I think that's what you're referring to, right? Earned wage access is not a loan. It's also not an advance on your salary. So I will explain earned wage access is this. It's basically an employee benefit that is offered by employers to their employees, which enables them to have access to a portion of their earned but unpaid wage before salary. So I'll give a good example. So let's say you have an employee that earns 60,000 naira a month. That pay is earned over 30 days, right? Because we have a 30-day pay cycle. Now, let's say at the middle of the month, that staff has an urgent need for cash to meet sudden requirements. An emergency came up, medical bills, that call which we all get from the village sometimes as Africans. And you have that situation, and this staff doesn't have to go to a payday loan company to meet that, where most people meet that need right now. All they have to do is assess what they've earned. So if I earn 60,000, mid-month I've earned 30,000, so to speak, but I've not been paid for. So I can assess a portion of that of which I've earned, which is 30,000, to meet that need, instead of actually approaching the payday loan company to take a payday loan. Yeah.
All right, thank you. Please put your hands together for Gerald. Clap for Gerald. I'll be taking Pere now. Pere is a lawyer. When I put it that way. So, Pere, tell us, do you think we have enough regulation in the technology fintech space?
Okay. So specifically in the technology fintech space, right? Well, as we're aware, there's a primary regulator for the fintech space, which is the CBN, right? And I think I would say that the space is regulated to a very large and good extent, if I would say that, right? So we have various guidelines that the CBN has issued. Of course, regulators and regulations will always follow technology.
Right.
It's like a way of life. The technology is going, and then the regulators have to catch up. So they're always playing catch up. I don't think you can ever have a time where regulations and the technology are at par. But the regulators can do their best. They can understudy the space and then put out regulations to regulate the space. And I think in that regard, CBN has more or less done a fine job. Yes, maybe not 100%. Maybe maybe people in the tech space can also, fintech space can also say that they've had some issues with some form of CBN regulations if we want to go into cryptocurrency. But in general, in terms of payment processing and all that, because fintech is a very sensitive area. It's people's money we're talking about. So there could be some form of over-regulation, but I don't think that we have gotten to that level yet. And in the aspect or in the areas where CBN is not really able to regulate or they can't understand the technology, they have their sandbox program. Okay, we don't understand what this fintech is about yet. We don't want to stifle this innovation. So come into the space and let's understand what you're doing. And we can see if we can put you into an already regulated area or bring a regulation to more or less just foster the development of that fintech space. So let's not limit these guys. Have they put out regulations that people have not fancied in the fintech space? Yes, like I said, the cryptocurrency, a lot of persons have some issues with that, or why can't we trade through the official channels? Maybe some other countries, cryptocurrency may not be a legal tender, but there's not been any ban. We still have access to official channels and we're able to do our businesses under the radar of the regulation. But what CBN has done in Nigeria is more or less take out these guys from the radar of the regulation because they don't believe. Of course, cryptocurrency is very volatile and understandably so. So yes, I would say that there has been a lot of regulation. Even though, of course, CBN is not the only regulator. We have the SEC and we have NDIC and the rest. But I would say that the fintech space is somewhat well regulated and of course we're getting there.
Thank you very much, Perry. Thank you very much, Perry. Please put your hands together for Perry. I'm going back to Nasiru. So Nasiru, I play very well in microfinancing, microbanking, and we do a lot in financial inclusion. Yes, there is the data that keeps jumping up and down that Nigeria is currently about 65% unbanked. That's the data that we keep hearing. If it's true, I don't know. You do a lot in agency banking. So tell us, how is agency banking driving financial inclusion in Nigeria?
All right, thank you very much, Wale. So agency banking, per se, it's the essence of financial inclusion or exclusion to a very large extent is a mirage. It's quite multifaceted because you look at the FINA report year after year and you see that 65% underbanked, 65% of Nigerians are financially excluded, majority of these people are in the north, but yet you go to an Ikorodu bus stop today and you see about 12 people doing agency banking. You leave Ikorodu bus stop and you go to somewhere in Ijebu and you see about 50 people at the bus stop doing agency banking. So in the real sense, right, yes, agency banking is doing a lot in driving the financial inclusion, but there is more to financial inclusion than the memoria that is actually collecting your cash to transfer money to someone.
So what is this financial inclusion? Tell us, what is financial inclusion?
So financial inclusion basically is, in a layman's language, is saying, how do I take an Alajuno's money that he prefers to keep in his house? How do I pass it through the financial system such that I can record it as part of the country's GDP or the country's income or real income? But in the real sense, right, we are not exactly doing that when it comes to agency banking. And that is because a lot of us believe that, or a lot of the investments in agency banking is quick. And we cannot wait for the longevity of that investment. Longevity in the sense that POS terminals alone will cost about 150,000 naira, and you can't wait for about 2 years to recoup that money. So, per se, it is difficult to now convince an Alhaji Musa to say, bring your money to the bank, let me help you pass it through the system, because he doesn't even trust the financial system in the first place.
I'm still staying with you. So the lending industry, micro loans, nano loans, do you think the risk in this industry is mitigated enough? do you think individuals, corporates, or organizations like ours can do more to beat down this risk?
Okay, so that's question to a very large extent. I think it goes down to the person, the borrower's borrowing behavior per se. So you have someone that is coming to your bank to take a loan with the intention of not paying back that loan. So, and that is because most people believe that nothing can be done when it comes to they will tell you it is a civil issue. You and the person should find a way to sort it out. But in the real sense, it is doing a serious damage to the firm that is giving out this particular loan, because the cost of loan itself is quite high. The cost of that investment is quite on the high side. So I feel there are like two different ways that we can actually mitigate against this risk. The first one is leveraging on metadata. Now, let me explain what I mean by metadata. Now, metadata is, you see, those data that are non-transactional that you can find about the individual before you give him a loan. For example, you have, authorized access now to the person's BVN, right? And you're able to see the person's SMS or the person's SMS trend. And you notice that this person does this particular set of things. Not his SMS alerts now from his banks, but other things that he does. You see that you see check the person's browsing history. You see what the person does typically. Again, like I said, authorized access, so that you don't fall against the data protection regulations and the like. And the other thing that I feel we should do again is Nigerian governments can actually come up with the use of credit scores or credit ratings on our daily lives in Nigeria. So I shouldn't be able to rent an apartment if my credit score is very, very low. I shouldn't be able to access some basic amenities in Nigeria if my credit score is very low. I believe this is what is done in more civilized climes. And it should be, if we can adopt that in Nigeria, I am very sure that 100% of Nigerians will not borrow money with the intention of not paying back the money. Thank you.
Thank you very much. Please, if you are watching online or you are here in the hall and you have any question, put it down. We will be happy to answer or take any of your questions. Thank you. I'm going back to Gerald. Gerald, HR tech seems to be coming online to the mainstream. Tell us, in the last 12 months, 24 months, what has been the influence or the inroad of HR tech in Nigeria?
Thank you for the question. So I was privileged last year, early this year, to be at the UK Tech Week, and I was on the breakout sessions, one of the panelists. And we're talking about future of work. And two things stood out from that conversation. And it was the issue of, we talk about 2021 being the year of the Great Resignation. And people were leaving their jobs for various reasons. In Nigeria, it's termed differently. I think it's called Japa, right? Not the Great Resignation. People are trying leaving. And it's not a tide that is about to abate. PwC came out with a report, that was a survey that was carried out in 48 countries around the world with 54,000 workers. And it says that in 2022, 1 out of 5 employees will resign from their jobs. So that's why this year has been termed the year of the employee. And back to your question, how does this connect to HR tech, right? People are leaving their jobs for several reasons. You can get career stagnation, rising cost of living. They don't see where they're going with their job. Yeah, they don't see opportunities to scale. Pay was also a major factor for most people that are leaving their job. And the COVID brought about a whole new way of how we work. We had remote work, became a thing in Nigeria. Now we moved back to some kind of hybrid work for most people. You could blend the work. But the trend is also going on, like I said. So you want to, as an HR tech expert, you want to look at how do you retain skills locally? Because now you are competing not just against, location is no longer an issue, right? I can be living in Nigeria and be working for a client in the US. So I'm competing with, as a company with a company in the US. So Amazon So you work for a bank. Your competitor, the person that's trying to get that talent is probably a bank in the US or one fintech company sitting in the US who has a lot of money to spend. And when you convert the rates, the staff is looking at, okay, what am I doing here? I should work somewhere else. Nomadic jobs are coming now. If I cannot work in Nigeria because for whatever reasons, regulatory issues and all that, I can relocate to countries like Dubai, like Lithuania, Estonia, get a nomadic visa, stay there, and work for companies without having to seek residency in the country where I really want to work, which is a US company. So these things so tech companies are actually coming to come together and say, look, how do we get skills, irrespective of where they are located, get them settled in work? How do we provide staff? Nowadays, you have to look at, we talk about customer experience. We're getting to a place where you have to think about the employee experience in recruiting your staff. What kind of experience does this employee want? A Gen Z is different from a millennial in terms of the Gen Z guys want everything. They want it all. They want to work from home. They want to work in their pajamas. So how do you make them work for you and deliver productivity without you trying to constrain them as to how they would live? And so all of this trend that's been affecting is what we're affecting. So you have to look at, as for an HR tech, as I said, like I always say to people, I say, look at what are the reasons that led to the Great Resignation. If you can look at those reasons and trying to use technology to fix those problems, right? And that's what we're doing at Paymaster with end-wage access. Give people access. People want to be paid on demand. I don't want to wait till payday. I've worked for today. Pay me for what I've done this week. Don't tell me to wait for it because I didn't earn it on payday. I earned that money today, so why can't I have it, right? I've worked for it. So those are the issues that we're dealing with. So you have to be more flexible. We're going to see where contracts are going to be specific. So I'm recruiting 2 people for the same role, right? And one has a different contract because I'm going to profile that person and see this is how this person wants to work. This other person wants to work this way. There's a trend that's also going on globally called shared jobs. So I can apply for a job and 3 of us will do it together officially. So I apply for the job and I tell the employer I'm going to do 60% of the job. He's going to take 20%. The other person is going to take 10%. And it's allowed. So the whole world of work as it is changing altogether. So that's the future of work. And for us as a country, we must key in if we want to make impact. So I said, well, we need to move away from discussing, especially at tech companies, customer experience and product market fit. We need to start discussing the employee experience and how do we have employee organization fit. Thank you.
Excellent. Thank you. Thank you. I'm still staying with you. You have touched a nerve. For business owners in this hall, the Jackpot syndrome is an issue. Some people agree with me. You have a situation where a member of your team walks up to you to say, I need to have a conversation with you. When they come and they say, I need to have a conversation with you, there is that palpable fear. Are you leaving? So I'm going to be holding you. I'll be asking you and Perry, our lawyer, in-house, what should tech business owners, what should we be doing differently to retain staff, to reduce this Japa syndrome? I would like you to speak to that.
That's a very complex question, but I'm going to attempt to answer it anyway. I was just talking to somebody in tech, when something we're trying to do together, and he said, I was saying, look, I should get you arrested. You guys are messing us up and all that. And he said, you know what, it's not our fault. The whole tech team just resigned 3 weeks ago. And I said to him, I think one thing we should start doing is to start creating redundancy more than ever before. So I think we need to go back to the days where you have somebody on the job and there's somebody understanding the person from the one. Like another study, knowing what the person is doing. So you don't have that sudden gap because this jackpot thing, there's no notice. Like you said, once they say that question, that's the notice, and they are gone the next day. I was talking to a friend that works in the bank, and he said they wake up every Monday and they find out that 1 or 2 branch managers have gone. They have branches without branch managers. And people living are not lower level staff. These are people that they have your core institutional values and all that. So you are looking at how do you start all over again with these guys. So first you create, like I said, create redundancy as a stopgap measure. Then I go back to that first question. Why are they leaving? What can you do to retain them? And it's not one cap fits all, really. Because A millennial's need is different from, like I said, a Gen Z need or somebody who's a baby boomer. So you need to look at what can you offer the person. And there's a lot of talking, and we do that now. It's like you have to keep talking to these people, like engaging them, buy into the vision. I think employee share scheme should be more of a norm now than an alternative. Like it should be not an option. They are working for you, they are building the profits, then let them, they should have a share of it. So things to just keep people have like a sense of belonging. And look, I don't just come to work here. We're doing this together. We're building something for the future, especially in the tech space. We're going to turn this company to a decacorn, to a unicorn. And you're going to be part, and Gen Zs want to be part of something, right? That's the major motivation factor for them. They just want to be part of creating something that's unique and different. So you want to be able to key into that dream and say to them, and say, look, they're not just going to be part of something, but you could also benefit from it other ways. And I think if you can marry that and probably use some AI to create some employee models where you can say, okay, this is a fit for my industry, for my company, or for this role, then maybe we could just solve the query. Thank you.
Thank you very much. I'm not sure if a couple of business owners will agree with you, though, but thank you.
This is what it is.
Ferry, what do you think? Do you think we should begin to look at legal angles to this business? Should we have staff, members of our team sign 5-year, 7-year, 10-year contracts and just keep them instead of jackpying?
Okay, so in terms of contract, right, you can sign anything, and these employees can agree at the time where they want to sign this contract with you. So if you say, let's sign a contract and it's a fixed, let's assume that would then be like a fixed term contract and you have to be here for 5 years. If you leave before 5 years, then you pay back this amount and pay back this amount. That's something that can be done. Again, though, it could be subject to review. So assuming the employee decides to leave and you say, oh, I want this money back or I want this back, and the employee doesn't have it, or has even, like you said, jackpot, so you go to America and bring him. When you check the costs, right, in terms of on paper, would it work? Yes, maybe it will work, but in practice, maybe not. And just like you said, maybe one other way you may want to look at it as against a compulsion to work for a fixed period that is not certain. Maybe if you give them a sense of belonging, it's not certain again, like I said, right? The world is a global village now. What a Nigerian company may offer in terms of shares or stock, and if an American company was going to offer that, I'm sure most people may want to go. But a sense of belonging. So if I were to go into a company and I wasn't just being paid, or it wasn't just about my salary, and I had some shares, which is why you have an employee stock option plan, and it's becoming very rampant, and they have a sense of belonging. So I'm not just working here as an employee, I own a stake in this business, and their ideas, more or less, their ideas and whatever they do in the company they're taking aboard, right? Even though the society in general, the environment may compel them to leave, there's only so much you can do. But I'm sure with stuff like that, people are very inclined to wanting to have a sense of belonging and ownership. So if you offered an employee an ESOP plan, right, and if they had to stay for a period of time for that share to then vest, they would stay. So let's say, oh, you get 5%, I'm just giving an instance. If you stay for 4 years and this 5% will vest over a period of this 4 years, it gives them, it helps them. It's more like an incentive as against the compulsion of sign 5 years and don't leave, right? You can't really hold them down. So this is a better route, I think.
Okay, I like the percentage idea. I think that works. I'm going to still stay with Perry for a while, and one of the issues that I know affect technology business is fundraising. When people are about to go into the market to raise funds, or they've raised funds, and then something happens to the co-founder, or something happens to the CEO, and the business may or may not continue, or, the way you're raising money, you leave them stranded. Perry, please tell us, what are the legal structures that people need to put in place during fundraising? You're speaking from both the fundraiser and also the sponsor point of view. Thank you.
So in terms of fundraising, right? Um, which one of the basic, which I'm sure before anybody even wants to raise fund, right? To a large extent, you would have incorporated your company. That's almost very basic. Although not always the case, you find some persons with ideas, and maybe you have family and friends sponsoring your venture. At that point, you may not have a legal entity. But if you're really seeking to raise funds from persons who are not maybe investors like PCs and people who don't have a direct relationship with you want to have a certain level of legal structure in place, not just legal structure, of course, financial and business, but I'm speaking to the legal structure for now. So you want to have your company incorporated, not as a business name. There are different forms of company, right? So personally, if I were going to invest in a company, I would invest in a company that's a limited liability as against a one-man sole proprietorship business. So that's one thing you want to have in place. And another thing you want to have in place as well is also your corporate governance structure. I think the masterclass speakers from Udodoma spoke on that, right? Where you have a proper board setting. It's not just run quote and unquote as a strict family business where it's just me, my child, and my husband who are directors of my company. But so I'm speaking from the startup perspective now, or the investor looking into the startup perspective. So if I come and I want to invest in a company, I want to see that you have at least a certain level of legal structure and compliance. I'm not expecting that you would have fulfilled all your compliance checks, but to a large extent, I want to be sure that your corporate structure is the right one. I want to be sure that you have the right people on board. In terms of employees, I also want to be sure.
So hold on, Barry. So is it okay for I and my brother to start a company? So I am the CEO, my brother is the CTO. Is that a problem?
That's not a problem. I spoke about corporate governance structure, right?
Yes.
So not necessarily the shareholding. That may not be, it depends ultimately, right? So if your brother is a CTO, he has the skills, and you can show that he has the skills. There's really no issue as to that. But if it's just for the purpose of he's my brother and he holds this role just because he's my brother, some investors may be skeptical, right? Not that doesn't mean that they would not invest, or that doesn't mean that it's not a legal structure for investment. But if your brother, I don't know, I think one of the product pitch guys, I don't know if it's his brother, but I saw the names, right? And if they both have the technical skills and they're able to bring it to bear, and they show what each person brings into the business, if I'm investing in that business, I wouldn't have an issue. And then again, I would look at your director structure. So it doesn't have to be limited to shareholding. I was also going to add, again, in terms of funding, so if you were a fintech or any other, I think fintechs are mostly regulated. You want to have your licenses, right? So I would not think that an investor who would want to invest in a company knowing that that company is in a regulated environment doesn't have a license. If you don't have a license, get a partnership, something like that, but make sure that your business is legally poised for these guys to invest their money, because investors do their DD. Sometimes maybe they don't, but for the most part, investors who know their salt and have their, more or less, had a series of investment and they know what to look out for, they would definitely be looking out for a certain level of legal compliance. Nobody wants to invest into liabilities and penalties in the future and risks and all that.
Yeah. Excellent. Thank you. I'm coming back to you. What environment do we need to foster, given the new tech wave? A lot of people are playing in the fintech space, but now we are going further. We are talking about the agritech, the insurtech, even the HR tech, and of course the legaltech. But what environment? I know you play a lot in the micro space, the agency banking space. So what environment, what sector do you think we should focus on in this new revolution?
Okay, thank you very much, Wale. You see, if we say we should focus on a particular segment of tech, then the whole development will be skewed to a particular segment. And what we need at the moment in Nigeria is an all-encompassing growth, a growth that is all-inclusive. So let's take, for instance, a farm in Kebbi. I was in Kebbi sometime last month, and I tried to activate some agents. And I realized that my POS can get to that place, but they don't have network in that place. What that implies is that my PS is just an empty box when it gets to that particular location. So the people in that village actually need a sort of tech that will give them access to mobile services, mobile data services, even call services. And so it means going to that place means that even if I want to focus on the fintech, the mobile tech needs to play in that space. And then the agri-tech, because most of those people in that location are mostly farmers. So agri-tech needs to play in that place. The insurtech also needs to play in that place because they need to start insuring the food commodities as well, the farmlands, the produce, like Mr. Shegun mentioned earlier. They need to start insuring all of those products. So it is the kind of environment we need to actually encourage in the new era, like, as we're trying to actually portray, is an all-encompassing growth or environment per se. Thank you.
Excellent. Thank you. My next question will go to you. So, what are the hindrances in this tech space? He has spoken to. We shouldn't focus on just one business case. But from where you sit, what are the hindrances? What hindrances do you think will affect the expansion, or that is currently affecting the expansion of the tech space in Nigeria?
Thank you. I think it's spoke to one of it, which is I think infrastructure is a major factor that we need to look at. And I have to go back to skills again. People, if you're talking to an angel investor and you prepare your pitch deck, one very particular part, they say, look, we're not investing in your idea, we're investing in the people. So they want to know who are those behind this dream. So it's important that you get the right set of skills to make up your team. Now, with Jagba, people are leaving. I've seen some fintech companies where they tell you, and I say, we have 3 founders. One is in Canada, one is in UK, and one guy is in Nigeria. And I'm like, good luck getting some funding, right? So, but that's the reality on ground right now. So you have to find a way to really get the right set of people who are willing to not just buy into the vision, but commit. Not just get involved, but commit to making it. So I think infrastructure, people, their ideas that tons of sectors to be disrupted, tons of sectors. I was sharing with somebody that the biggest gym in the world, one of the biggest gyms in the world, does not own a single gym equipment. Not a single gym equipment. But the biggest gym in the world aggregating gyms. You get so, and those are sectors that haven't been touched. That's like a subset in the edtech. So there are a lot of things we can still do. And just because we're a growing economy, I won't say underdeveloped, we're a growing economy. That means there's so much opportunities down here to really explore and make money, so to speak. Make impact more like. So.
You are not speaking to some of our pain points. I feel you are avoiding answering some questions. So I will throw them at Perry. So, Perry, do you think, and I hope we are not getting into trouble here, do you think our chief regulator, names withheld, do you think our chief regulator is doing enough to support the tech development in Nigeria?
Well,
I didn't say no. Please, for.
Well, when you say our chief regulator is doing enough to support the tech industry, right, in general, maybe we would point to the Startup Act that has just been enacted last week. Would I say that's 100% enough? No, but that's like more than 50% crossing the milestone. So a lot of barriers to coming into the tech industry. A lot of persons are skeptical. There's so much cost, and maybe they don't have an enabling regulatory environment. They're scared of regulators coming after them or stuff like that. But I think what the Startup Act, which was recently and was just enacted last week. Actually, this is like barely a week, right? And that's a law that was put together both by the stakeholders and the executives, and even some of the regulators or one of the chief regulators, depending on the regulator you're speaking to, do, right? So it was a joint process for this act and for this law to be put forward. And there are a lot of incentives in this act. Incidentally, my firm led the team that prepared the Startup Act. Yes, exactly. So we took into cognizance, because we deal with the startup space. We have a well-blown startup practice, and we understand some of the fine issues that startups face. So we took into cognizance these issues when drafting the law, right? And we tried to limit as much as possible in terms of implementation, where you find that there are proliferated agencies and people don't know where to go. So we just put everything together in one space. So ease of access as well as incentives. Come into the space, you get a label, and once you have your label, you're able to get certain incentives in terms of tax credits. Even your employees and investors who invest in these startups get tax credits as well. So that would definitely boost. We are in for a season to see a boost in the startup space. It's been done in other climes, and the result has been, the numbers are there to show that once there was a regulation like this, the numbers went up. Investment in the sector, startups were springing forth, there were businesses, there were jobs. So I'm sure in terms of the Startup Act that has just been enacted, which the regulator also fronted, right? We would see a boom in the tech startup space. They may not have done enough in the past or be doing enough, but with this singular legislation, I can say that there would be a very tremendous growth in the startup space that we're yet to see.
So let me push you a little bit. What about in the financial space? Do you think our chief regulator in the financial space is supporting startups, tech companies to grow and to foster, or do you think they are pushing these companies back to retail banking?
Well, I think that was one of the first questions you even asked me, but apparently you were interested in it. So I would say, like I think I had said initially, that you cannot really regulate this space so much, and you cannot say that regulations have cut across the issues so finely that there are no more outstanding issues. But there are regulations, and the chief regulator in the fintech space has put out regulations, yes, for the most part, to govern and also to protect consumers, right? Because the idea is we're in a fintech space, we want to push our business, but then we have consumers that also needs to be protected. So to some extent, yes. In terms of maybe the threshold of coming into the space as a fintech, in terms of maybe capital requirements, there may be some fine lines in terms of how much I can have to come into this space, and that may stifle, or you may say maybe has impeded some persons from coming into the space. But to what extent can you fault them? Because their policy, there are reasons for these decisions, right? But maybe one fine decision that everybody has taken a view that, oh, why did you have to ban an official channel for this sector, for this vertical sector of the fintech, right? We have companies, we have people. It was a budding space, youth, young people, ideas were budding. Everybody in one form or the other wanted to come into this space. But once there was an embargo on trading through the official channels, people started reclining, and these deals or these things were now being done no longer in the radar of the regulators, but in form of peer-to-peer, right? But generally, I would say, other than that regulation that seemed to have impeded inclusion in that space, and maybe a few other fine lines in terms of regulations, and like I said, capital requirements and some other regulations, I would say that there is a fair level of regulation. We still have much to be done, but we're getting there. I don't think we're not there yet, but we will get there.
Hello, Shay. Well, can I just say something?
So I was going to say she's not part of us. she's supporting the enemy.
I don't know about the enemy part of it. You know, where they say that when there's a fight between an elephant and let me not say anymore. So, but just to speak to what Jerry said, like I think the Startup Act. I've not read the signed act, but when it was passed by both houses, I got a copy of it and I read the approved bill. But Nigeria, sometimes between approval and signing. So I don't know what changed. But what I read was really encouraging. I must say, it's.
Did you read the Twitter version? You saw yours on Twitter?
No, I saw. Well, maybe the Twitter version of it, but it was really encouraging. But talking about regulation, I think yes, would force regulators for a lot of things. That's true. But the truth is that there's nowhere in the world everywhere in the world regulation plays catch up with innovation. You have to play catch up. Innovation will always be 2-3 steps ahead of regulation, no matter how robust the agency or the regulator is. Yes, but you might say, okay, the way we react locally, maybe instead of what you don't understand, you kill instead of trying to get. So maybe that's where the challenge is to, instead of taking time to better understand and say, how do we ring fence? What are the risks around this? How do we ensure that those things are properly curtailed and minimized to the barest minimum? Because there's no way you're going to eliminate risk anyhow. We saw something today about a company in the US with all the regulations. $160 million moved, and they couldn't track it. So they're doing a good job, but can they do a whole lot more? Definitely.
Nasiri, you want to add?
Yes.
Go ahead,
I actually
please.
wanted to add.
Go ahead.
So for the regulations that we
Speak to your agency banking space.
Yeah, exactly.
Go ahead.
So today I find myself competing with a commercial bank when it comes to agency banking, and I shouldn't even have to do that on a regular day. So the thing is, I have the technology to reach this last mile. The commercial bank has the financial muscle to reach this last mile. So why can't there be some sort of fusion between the fintech and the commercial banks? Remember when I started my response earlier, I said most of the reasons why fintechs cannot actually do a lot is because they do not have the financial capacity to reach this last these unbanked areas. And the reason is this: I have an investor who is giving me his funds to say, let's say, a year at a particular rate, and I am using this money to buy some POS terminals, using to pay for some expertise when it comes to tech. And I must make sure I get that money back before the end of the year because I have the investor breathing at my neck. So the point is, if I will add the financial capacity or the financial muscle of a commercial bank behind me, and in this case now, let me get into some technicalities. I'm using your TIDs. That means I'm moving all of this money, these collections, to your bank. That means everything I am doing is working through your bank, and I'm leveraging on your wallet system such that the money is leaving your bank into another person's bank and coming back to you. One way or the other, you are enjoying everything you are set out to enjoy as a bank. And that way I'm enjoying the trickles, the 1 naira that I want to make per transaction. I am making it, and everybody is happy. But today, I find First Money having 100,000 agents. I find Access Closer 50,000 agents. And how do I cope? How do I compete in that kind of market? So I am typically set out to already fail unless I get foreign investors. That's why someone like me will not start looking for seed capital. And how many venture capitalists
And have access
to such
excellent.
finance?
I mean, we can go on and on. They say time flies when you're having fun. I'm sitting with intellectuals here, and in 1 minute each, I would like you to put in your final statement. And my question to guide your final statement will be where we are today as a country, as a continent. Do you think we are doing well in the fintech and the tech space compared to other clients, compared to other parts of the world? I'll start with you.
Thank you. I think Africa as a continent is the future for tech, especially the fintech, because we have the numbers. We have the need, so to speak, the pain points that fintech companies are trying to solve are pretty much resident in Africa. So I think it's a no-brainer, and probably that's what drives the investment that's coming into the space in Africa. That yes, I'm pretty much excited about the future, about what we can do, and it's also amazing to know that in some certain areas we are way ahead of some of these developed worlds in terms of technology in the fintech space. I was talking to somebody from Switzerland and says if you give him a check, it will take him 7 to 12 days. Even in the US today, if you catch a check, I'm like, it's T+1 in Nigeria. you get value immediately. So you can imagine, so we're not doing so badly, so to speak. So, and because there's so many problems, and I always say solutions gravitate to where you have the problems, and the problems are here. So the future is exciting for us as tech entrepreneurs.
All right, so just to take a cue from where you stopped, the future or the future of tech in Africa or at the world or in the world at large is domiciled in Nigeria, and I will be saying this because um, there is a lot of problems. We have a lot of problems that can be solved by technology in Nigeria. I mean, today we've not even tapped into any form of solution to all the major problems that we have. So I believe that the deeper we get into trying to get solutions to this, the more elaborate or the more robust our tech spaces and the more revenue we can generate.
Thank you very much. Mary?
Okay, so while I would say that we're not where of course, we're going to, but there is traction. Maybe mistakes may have been made both by the startups and maybe the regulators. Maybe startups in terms of not seeking enough legal, getting enough legal expertise on their team to put things together. And then also in terms of the regulators, maybe not studying the ecosystem as much to regulate it in such a way that people feel that you see them, you understand their business, and your regulations are being put out to foster their development, not to inhibit what they are seeking to do, because Nigerians are thriving. We want to build this, we want to build that, we want to do this. They just want to see a regulator that, if I see someone who shares in my pain, and maybe I feel you understand and you tell me what to do or how to do it, I would appreciate it more than if you came at me in a draconian style and trying to penalize me for everything. So I guess in that manner, both sectors, both the regulators and the startups should, put their radar down in terms of legal and regulation to ensure that there's development in this space.
Please put your hands together for our panelists. Excellent, excellent people. In discussing the topic, charting the new tech path, insurtech, agritech, with me this afternoon has been the amazing lawyer, Temi Pere, senior associate at Alex. Alex is a law firm. Mary, thank you for coming. Really happy to have you. And also people penetrating the nooks and crannies of Nigeria. Nasiru Shonoiki. Nasiru is the head of agency banking at Liberty Pay. Liberty Pay is an agency banking company. Nasiru, thank you so much for coming. And finally, with me today is Gerald Eri. Gerald Eri is also the CEO and co-founder of Last Mile Financials. He has been everywhere all over the world. Thank you so much, Gerald. And I'm your host, Wale Olajubu. I'm the MD Asset Microfinance Bank. We do banking and we do it well. Thank you for joining us this afternoon.